Hi everyone, it's Alex King from Cestrin Capital Research here. It's Monday the 20th of January. It's currently 4 p.m. Eastern for the benefit of the tape. Welcome everyone to our newsletter service webinar. We have a fairly tight schedule today. We have a hard stop in 40 minutes, so that should be fine to get things covered. The point of the webinar today is just to walk everybody through how we choose the picks in the newsletter system, and also to explain to you what the pick system is, tell you a bit about ourselves, and we're going to talk about a couple of one worked example to illustrate the point. We, in all our webinars, run on a live and open mic basis. So the platform here, GoToWebinar, if you have audio connected, if you have a mic connected, you can just shout into the system if you have a point to raise, a question, anything like that. So on my side, everyone is unmuted. So all you need to do, if you have a point to make, question, agree, disagree, anything like that, just unmute your side and chat. I will stop periodically for Q&A, but interrupt anytime. Okay, so our agenda today is on the screen right now. We're going to run through a disclaimer in a moment, tell you a little bit about the firm, Cestrin, and then walk you through the newsletter pick. So first of all, talk about what the pick system is. We work within Seeking Alpha's framework here, and then tell you a bit about how we come up with them. How we look at the underlying companies, the financial fundamentals, and how we look at entry and exit timing for the shares, and then we'll take Q&A. Again, any burning points, make it on the way through. Okay, so first of all, we'll do our disclaimer. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Cestrin Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Cestrin Capital Research. Cestrin Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so back to our agenda. I'm going to tell you a little bit about the firm to begin with. So we're fairly unusual insofar as we are pure play investment research business. We do nothing but research. We don't do capital raising, we don't do IPOs, we don't do M&A, we don't do any kind of capital markets activities except research. We're very serious about it. We're serious about our independence. We set ourselves up as an SEC regulated business to underline that. We are, in the modern idiom, 100% online business. We're headquartered in Newport Beach, California, but the business works entirely online and entirely distributed. So all of the authors and contributors and indeed board members of the company live in different cities and places around the world. It's been that way from the off. That was a sort of necessary function of when the company got started during the COVID crisis, but actually it served us well and we continue that way. I'm Alex, I'm the founder. My background is 3 decades of professional technology investing, which spans both venture capital, leveraged buyouts, and public market securities. And in addition to myself on the board of the company, Wes Nissen, who is my fellow board member, is an independent board member, and his background is he's a long-time senior securities lawyer, a partner in a senior Chicago firm. So we have a strong compliance culture. In short, we try to do the job properly. Our authors, we recruit from around the internet as we find them based on skills. So we have folks who are strong on fundamentals. We have folks who have operating experience where they've run companies or stepped in as turnaround agents at companies. We have technical analysts, macro analysts. We have in particular a great former professional rates trader who does our Fed work for us. We have folks who are strong on options and so on and so forth. And so what we try to do in our business is cover the whole gamut of what it means to invest and trade, and we apply that to stocks and ETFs. And the sectors we cover increase all the time, but it began with tech, defense, space, and we've since moved into some commodities, uranium in particular, and also the indices at large. So all 4 of the major equity indices. focuses entirely on stocks, a little bit of option work these days, that's growing. Nothing in futures and nothing, nothing material in options. That's just a start for us. And we run multiple level subscription services. So you can pay as much as $8,000 a year for our services and as little as $49 a year and everything in between. If you're interested in finding out more about those services, check our website. There's a link in chat here. It's cestrincapitalresearch.com. Tells you all about it. Okay, so the core of what we do is the fundamental coverage universe, which we call Cestrian Stock Central. So this is just a snapshot from that on your screen right now. This is as displayed in our full Growth Investor Pro service on Seeking Alpha. But we cover, I think, 60, 70 stocks and ETFs now. And this resource, we have, our current rating, latest chart update, when the next earnings date is, links to our most recent earnings reviews, and so on and so forth. This is our sort of core database of what we do. And from that, we work through these and look for selected items to choose in this newsletter service. Now, I'm going back to the agenda here. The first question is, what is the Seeking Alpha pick system? Well, let's get the newsletter service on the screen right here. So this will be familiar to you if you've been a member here for a while. And if we just look at picks over here, these are the currently open picks, and these are the closed picks here. Well, what is a pick? Well, we work within Seeking Alpha's system. So we were delighted to be invited by Seeking Alpha to be one of the first providers of this new newsletter platform. And it's a very simple system. They allow you to choose an entry, which is always a long buy, and choose an exit, which is always a sell. And right now, there's no ability within the system to do things like, average down or hedge or sell a little bit and then buy some more later. It's a very simple binary system. Pick a day that you're in, pick a day that you're out. And in addition, we want this service, which is super low cost. If you sign up now, you can pick it up for sometimes as little as $49, depending on what promotion that Seeking Alpha are running. That's always a year one discount. We want it to be a taster service for our other full services. So for us, this is about, collating and compacting the work that we've done on these stocks elsewhere and presenting them in a really simple way. And we hope that, first of all, people get value from the service as it is. And then if people want more, they can look at our other services and upgrade. And we offer, as you know, because we always tell you, deeply discounted upgrade paths to, for instance, our full Growth Investor Pro service on Seeking Alpha. So because the pick system is really simple, in, out, that's it, that's all you can do. What we're looking for here is low risk gains. So we're looking for stocks and ETFs where we can pick an entry point, where we can be reasonably confident that, if time passes, a gain will follow. And we can be reasonably confident that if, the pick does go against us, if there's a sell-off or whatever, then just waiting will solve that. And so far, that's worked. And what you'll see in the picks thus far, if you look at the closed picks, is, we've deliberately closed them off when they've hit basically low double-digit returns. So what we're not trying to do in this service is pick swing for the fences, YOLO, hero or zero type opportunities. Because again, this is it's a simple entry-level service. We want people to get a flavor of the work, and we want this to be a nice, low risk singles and doubles type of set of picks. The system doesn't allow us to do things like average down if it sells off a lot, sell parts, and so on and so forth. So we just like to keep it simple. And so what you'll see in the current picks here are some are in the money, some are not. Some of these have been deeply out of the money, and as the market's recovered, they've moved up. And with each of them, we've remained confident that they will be profitable in due course, which we remain of that opinion. So if NVIDIA here keeps moving up, and if that gets to 10, 12, 13, 14%, we'll probably close that out. Ditto the RETL, ETF, and so forth. And so each time we post an entry or an exit, we'll lay out what we think of the stock, how far we think the stock can go and why. You'll see a chart, you'll see some fundamental analysis, and Maxar is a great example of this. So in the closed picks, we closed Maxar out at just over 21% return, which is obviously perfectly reasonable in a couple of months. The company subsequently got sold, and had you held beyond that, you could have made a lot more than that. We're really clear about that when we wrote the note, and when we wrote the exit note, which is some solid gains banked here. There's plenty of upside if you want to keep holding. And what we also do is explain really clearly what staff personal accounts are doing here at Cestreum. So we'll tell you in the entry note, do we own the stock? Do we plan to buy the stock? And we'll tell you in the exit note, are we selling? Did we already sell? Are we going to sell in the future? Are we going to hold? So the idea here is that we can set up a simple in and out system to chalk up, good solid gains, but crucially that we give you guys all the information you need and the analysis you need to make your own decision about, is this a good idea for me and my risk profile and my appetite? Is this exit now? Does this suit me? Do I want to hold for longer? Might I have sold earlier based on the entry note? This isn't meant to be a model portfolio or anything like that. It's meant to be some good solid picks with a ton of analysis to help you make your own decisions as well. Okay, so let's run through how we come up with these picks. So I'm going to switch back to presentation here. Okay, so we've said that we have a universe of, say, 60, 70 stocks and ETFs that expands all the time. And the first place we look is fundamental company analysis. So there's a simple table on the screen here, which is, just a few items down the left-hand side and what good looks like on the right-hand side. Revenue line, we're looking for businesses or ETFs that contain businesses where they're growth companies. That doesn't mean they have to be, 100, 200% a year. It does mean they have to be growing somewhat. It also means that wherever possible, we're looking for growth which is predictable. Now, sometimes that's contracted. Some of the businesses in here, Snowflake's a great example. There is a huge amount of pre-contracted, both prepaid and yet to be prepaid revenue, which you'll see pop up in remaining performance obligation, which is the total customer contract book, and you'll see pop up in the deferred revenue balance, which is that part of the contract book that has been prepaid but yet to show up in the revenue line. So we're looking for growing predictable revenues. Gross margins. Now, gross margins, if you're not familiar, is a very simple thing, which is you take the revenue and you deduct all the variable costs. Variable costs are all the costs you incur in order to achieve any revenue at all. The chairs you buy for the office are not a variable cost because you need chairs in the office whether you sell anything or not. If you sell cars, then steel is a variable cost because if you don't buy any steel, you're not going to have any revenue. So gross margins, we're looking for high gross margins both on an absolute basis. So the software stocks we cover typically have 70, 80, 90% gross margins, and or margins which are high for the industry. So Taiwan Semiconductor, for instance, doesn't have anything like the gross margins for software business, but they're high for the industry. So it's an outsourced manufacturer of other people's semiconductors. And right now it's sat at high 50s, low 60s gross margin, which is exceptional for the industry and for the company's own history. We then look at cash flow margins. We don't take any notice whatsoever of earnings per share, none. Obviously, Wall Street does. There's plenty of other places that do. That's great, but earnings per share is not a real thing. It's an accounting concept. It's not real. Cash is real, and so we look at unlevered, pre-tax, free cash flow margins. So that means what is the cash flow that the business produces after it's paid all of its costs, after it's funded its capex, its capital expenditure, after it's gone through its what's called change in working capital. That's basically did I get paid quickly by customers this quarter or slowly? Did I pay my suppliers quickly or slowly? But before it's paid the IRS taxes, before it's paid any dividends, if it pays dividends, before it's paid for its debt service costs, if it has any leverage, basically what is the money, the actual money the business spits out? Take that number, usually on a trailing 12-month basis to smooth out quarterly variances, and divide that by trailing 12-month revenue. That's a true measure of the cash generation potential of a business. So we use that. And again, we're looking for companies that have high absolute margins. So some of the software stocks we cover will be 30, 40% cash flow margin businesses, or high margins for the industry. So if I were to look at, actually Taiwan Semiconductor is a good example as any other. It's a pretty high cash flow margin business for the industry it's in. Balance sheet. Okay, we're looking for balance sheets which are, we say, fortress-like. So balance sheets which have a lot of cash on the balance sheet, which if they have debt, it's debt that is manageable, both in size and term and so on. And in essence, companies which are not going to need to raise money anytime soon. And the reason to do that is because if you have a flaky, weak balance sheet, and we have a market like 2022, it can be difficult to raise capital at all. Or if you do, maybe the debt has to be expensive or the equity has to be highly diluted. So we're looking for really strong balance sheets. Not every single one of our picks have that. So Spire Global, for instance, which is a closed pick that did really nicely. It's a very young company with a very thin balance sheet. We'll always flag those sorts of risks. Valuation, what we're looking for, the valuations are, the entries are more technical than fundamental, but ideally what we're looking for is the point at which we call an entry to a stock is that the multiple of revenue or earnings or cash flow is low versus the stock's history or versus the industry, or low versus the growth rate that it's achieving at that time. And then at exit, ideally, you want a multiple that's high versus those same things. Now, again, we don't apply this universally. The entries and exits are more driven by technicals than they are fundamentals. So this is the perfect what good looks like. Okay, any questions before I move on? If anybody has anything to say at all, just unmute yourself your side and chat. So everyone's unmuted my side. So do take the opportunity if you have anything. Dominic, you got your mic open.
Yeah, just a question. So on the entry points, do you recommend then if you're going to enter a position that you do it all at once, or to kind of average into the position to kind of smooth out?
Yeah, that's a great question. Yeah, that's a great question. So in short, no, we if you look at our ratings, we'll rate things that accumulate, market, hold, distribute. And so the idea there is build a position over time, as you suggest, hold hopefully while it's going up, and distribute, sell slowly over time. So we'll come on to that in a couple of slides time. It's a great question, thank you. Anyone else? Erin?
Can you hear me?
Yeah, I can.
Yeah. Okay. Question I had was, I was looking at the closed positions, and it looked like an average of 1 to 2 months hold. Is that the average?
No idea. So each of these that we've closed based on the return rather than the timing. But I mean, we're looking for solid, relatively quick wins here. But if we have to be patient, I mean, if you look at it's a bit self-selecting actually, because if you look at the current picks, so I'll just switch on to that slide right now. So these are the current unclosed ones. Some of these are longer, as you can see. So, there's a S&P pick in June, right? Still underwater. So, we're 7 months into that. Reason, we thought the S&P would recover faster than it has. It's still an open pick because we're pretty confident that if you just sit tight and do nothing, that will turn into a profitable position. But clearly it's a lot longer than some of the quick ones. So no, it's a bit self-selecting where, if something's very volatile and swung up very quickly, we'll close it because, again, we're trying to establish a relatively low risk, chalk up some scores baseline here. So they're not timing driven.
Okay, thank you.
Great question, thank you. Okay, anyone else before I move on?
Yeah, I had another question. Do you employ any stop loss, threshold that if a position, drops a certain amount,
Sure,
that it's automatically sold?
The answer is yes, but we're not able to in this service. So when I walk you through an example in a minute, you'll see that each entry note usually says it will give you risk management levels included in the entry note. So it will say, we think this price range is a sensible price range in which to build a position. Up here, this looks like a good place to exit, and down here, if it's got down here, something bad's happened, and you may want to think about a stop down there. The pick system here, within which we work, it's Seeking Alphas, not ours, doesn't let you code those in. And so what we do is we put it in the entry notes, so they're there for everyone to consider. And of course, the other thing is everyone's risk tolerance is different. So some people are happy to hold through a deep drawdown and just wait. Others will set a really tight stop because they don't like unrealized losses. And again, we're not trying to run a model portfolio here. We're trying to come up with some ideas and lay out, how you can manage each of these ideas to suit your own financial and, frankly, emotional and psychological profile, and that's different for everybody. So we'll lay out where we think a stock can be used, but we don't and can't code them into the system. So you have to dig into the notes a bit for that. Okay, I'm conscious of time, so I'm going to move on. These are great questions. Thank you. Okay, so let's go back to presentation. Okay, so this is your fundamental selection, and not every pick will hit every single one of these, but that's the perfect pick there. Okay, and usually the picks will have many of those characteristics. Okay, I'm going to work through a worked example here. This is a current pick, Trade Desk, which is a software and services business. This was a pick in the middle of December. It's up a couple of points at the moment. It has been down a fair bit, but it's up a couple of points right now. I'm going to walk through why it was a pick. So the Trade Desk, if you're not familiar, is a so-called ad tech business. And very specifically, what Trade Desk does is if you're a brand and advertiser and you want to reach consumers on the open internet in all of its forms. So what that means is not within Facebook, not within Instagram, not within Twitter, but the open internet. So on web pages, on connected TV in particular, then you'll use the Trade Desk. And basically, they sit in the middle of two parts of the value chain, the brand on the one side and the digital real estate owner on the other. They're the leading provider of what they do. It's a public business, obviously, but it's heavily founder-owned and run business. And Jeff Green, the founder CEO, has done a fantastic job. And the company has grown really strongly for many, many years now. It's high growth, very cash generative, very solid balance sheet. And I'm just going to walk you through, hopefully you can see this on screen here, but so basically revenue line, if you look at the most recently reported quarter was September 22, so just shy of $1.5 billion of revenue. That trailing 12-month revenue was growing at 32% a year. So you've got $1.5 billion revenue base growing at 32% a year. That's not easy. There's not that many companies in the world that can do that. Gross margin, which you'll recall is revenue minus variable cost, 82% and trending up. So if you look back to the same point 3 years ago, 76%, the same point 2 years ago, 79, same point a year ago, flat, so 82%. EBITDA margins, which is a kind of operating margin at 41%, which again is really high, and cash flow margins, as all important, cash flow margins, 33%. So for every dollar that comes in the door, 33 cents turns into actual cash before you pay the IRS, or well, in their case, just the IRS, doesn't pay a dividend and there's no debt. And then the balance sheet, at the end of September quarter, $1.3 billion of net cash, no debt whatsoever, which is relatively unusual, doesn't pay a dividend, no debt. So the balance sheet, very, very strong, high growth, very strong position in its industry. And the ad industry continues to migrate from offline to online. And in ad tech in general, house thesis is that open internet will outpace walled gardens over time. Reason, nothing in the internet likes closed systems. This sort of stems my third decade of doing tech, and throughout that time, since the dawn of the internet, really, the internet has tended to entropy. It's tended to chaos and randomness, and tended away from closed systems. You can see that in the underlying networking technologies, and you can see it in the proliferation of sites that aren't closed, AOLs or Facebooks or whatever they might be. And I think the Trade Desk will benefit from that. So financial fundamentals, very good. Now, to your question, Dominic, about do you enter an exit at one point? That's not our model. Okay, on the screen here, this isn't TTD specifically, but I'll come on to a chart for TTD where we'll illustrate this. We like to use the Wyckoff cycle. Okay, now this here isn't a very idealized form, and as you can tell, very scientifically drawn, it's scribbled, but this is roughly how the idea works. The Wyckoff cycle was born of the notion that large account investors, big boring insurance companies, can move stocks and markets by themselves. They can use that by sheer force of capital. And so the notion here is that you'll see stocks that enter this up and down cycle, but they show distinct phases along the way. And if you can spot these, you can basically follow behind boring, big money account player and try to emulate what they're doing. And if you can work out what they're doing, then you're not taking so much of a risk by following these, particularly in the big liquid stocks. And this works for indices as well, by the way. So the accumulate phase on the left-hand side, so you'll very often see stocks moving in a sideways, range-bound sort of style. The S&P has been doing this since about September, October until last week, for instance. You'll then see a stock break out, let's say, to the upside. And in the Wyckoff cycle schema, you'll see that referred to as markup. And the idea there is that, big money, quiet money has been buying in this initial accumulate phase on the left here. And then late money comes in this markup zone. Now that can be smart late money, right? So you get many momentum investors who know what they're doing, and their business model is really simple. It's buy high and sell higher. Sounds silly until you think about it. But if you know what you're doing, then you just, chasing a stock up, but to get out. You'll also see plenty of dumb money here. So, retail investors will tend to enter towards the upper end of this markup phase. This is when, accumulate, too boring, no one wants to invest. Early stage of a markup, well, it's broken out, but it's not real, it's going to come back. In the middle here, wow, I missed that, I should have got in earlier. It's too late now, it keeps on going up, well, I better get in now. Classic sort of uneducated retail behavior. So this markup phase is the point at which, in this idealized Wyckoff cycle, a big money investor is just doing nothing because they've already bought their holding here. They bought it, piecemeal over a few weeks, months, even years sometimes, and bought it on deep red days where nobody wanted to buy it, just picking up bits and pieces. And then come the markup phase, just sit back, do nothing. It's called markup because the stock in your account is getting marked up by somebody else. Distribution, again, you can see this very often. The IWM, the Russell 2000 ETF, did this all the way through 2021. Big flat distribution range, which is basically slow, measured, controlled selling by large account players. Very controlled. So once they start to sell and the stock comes off a bit, they might then just buy a little bit just to keep the price up, and then sell a little bit as it reaches another peak, buy again as it falls down, and just keeps it in a sideways range. And then we enter the markdown phase, where basically there are no more large account buyers, and so the stock will just drop. And then we'll enter a renewed phase of accumulation. Now, this is idealized, obviously it is, it's scrolled on a page, but you see this time and again, and we like to use this in our investing and trading ideas. The technical method we use to try to spot this is a combination of Elliott waves and Fibonacci series. Now that sounds exotic and esoteric, but it isn't really. People overcomplicate these things and they imbue them with more science than is really there. The Elliott wave system is pretty good for measuring the ebb and flow of emotion in markets. And the notion at its heart is simple, which is people get happy in 5 waves up. So 1 up, happy, 2 down, sad, 3 up, very happy, 4 down, a bit sad, 5 up, happy, right? And then people get sad in 3 waves down. So basically sad, a bit happy, sad. And then it all starts again, roughly. And you can overcomplicate it, but that's the heart of it. Fibonacci method, which I'll show you in a moment on one of our charts, just put some numbers to the movements up and down. It's not very good on the x-axis. It's not great at predicting the time over which this takes. But on the y-axis, in other words, the price ranges, the so-called extensions to the upside and retracements to the downside, it's not bad at actually. It's better than you might think. So when we're looking for timing of our entries and our exits, this is what we use. We have the Wyckoff cycle in mind. And again, that doesn't work so great for tiny, no-name, illiquid stocks. But it does work quite well for the better names, for the bigger, more liquid names, and it works really well for the indices. And then with that in mind, we try to look at the wave patterns and the extensions and retracements and try to spot buy and sell opportunities in that. And that's the work that sits behind all of the picks in this system. And you'll see this work in the entry notes. So this is the trade desk here. I'm just going to switch on to a full screen chart. Just 1 second. Okay. Okay, so this is the trade desk here, and let me talk you through this. It looks complicated, but it isn't, trust me. So this is a black line 5-wave cycle from the May 18 lows. Okay, so we get a wave 1 up that peaks just in coming into the COVID crisis, Q1 2020, and then wave 2 down, which troughs at what's called the 61.8 Fibonacci retracement. You know, again, if fibs are familiar to you, great. If it's new, don't get phased by these. It's not very complicated. All it means is that it's dropped 62% of this move up. And these levels are meaningful insofar as, you know, algorithmic trading uses these things, and you can see it uses these things because they work too often to be random. So a wave 2 down is usually a deep, fast correction, and it often troughs somewhere between the 61.8 and the 78.6 retrace. We then get wave 3 up. Wave 3s are never the shortest wave, very often the largest wave, and wave 3 is the opposite of a wave 2. Wave 2 is a fast down slice correction. Wave 3 is a fast up move, and usually adds a lot of price in a short amount of time. And so here, from the COVID lows, we get a wave 2 trough at around 15 bucks. This is split adjusted, and then we get a wave 3 high. This is a big peak, so it peaks over the 2.618 extension of wave 1. Sounds complicated, isn't. All that means is you take the length of wave 1, the share price move in wave 1, which in this case was between 5 and 33 split adjusted, so that's a $28 move, and multiply that by, if it was peaked here, you multiply it by 2.618 and place that at the bottom of this wave 2 low. Again, it's not complicated, simple math. For a wave 3 high. We then get wave 4 sell-off that troughs down at the 61.8 retrace, which is a deep wave 4, but a common wave 4. The NASDAQ in its wave 4 right now, the 2022 low was at the 61.8 retrace of the prior wave 3 up to the dollar. And then in TTD, we get a wave 5 up, which peaked between the 61.8 and the 78.6 extension of this wave 1, which, of the wave 1 plus 3, which again, all you do to measure that is you take the move from the bottom of wave 1, top of wave 3, and multiply it by these multipliers here, place it at the wave 4 low. Sounds complicated. If you do it 10 times, it becomes second nature. And wave 5s, you can identify them because they peak just above a wave 3 high, and they usually terminate between the 61.8 and the 78.6 extension. Obviously not always. Obviously these things are, you know, patterns that they're to be recognized, and sometimes they're, sometimes they're not, but more often than you might expect, these things crop up. So when TTD was up here, you could be really confident it was going to sell off, which it did. And then what you're looking for is, okay, these 5 waves up form a larger degree, in the lingo, a larger degree wave 1. Each wave subdivides into 5 waves on the up, 3 waves on the down. So this is a wave 1 up in purple, and then a wave 2 down is what follows. If that's a wave 1 up, what must follow is a wave 2 down. And it is a wave 2 down because it retraces to, so the top of the wave 1 in purple, 113 bucks a share, and this retraces to between the 61.8 and the 78.6 retrace. So what we do in our work is we say, okay, an accumulation zone at the bottom of a wave 2, we'll say somewhere between the 61.8 and the 78.6 retrace. And why we say that is because these levels are recognized very often. Now, a criticism might be that's a heck of a broad range between, you know, $28 a share and 46 a share, but you know, we're not. The idea here is to build a position. It's not supposed to be a YOLO trade. It's supposed to be a you know, build up a position and then wait for the market to market up. The question on stop losses is we'll always place a stop zone on these charts. So here we've said, you know, below this 78.6 retrace, something probably has gone wrong in the market or with the stock or something. And then if you like to use stops, you probably want to place one down here. You can always buy back in, of course. So accumulation between these two Fibonacci levels, and then markup, we judge this as we go. Okay, so you could easily say in this pattern recognition system, what you really say is, well, markup is all the way back to the prior high, and I'll think about selling, distributing once you reach a new high. That is pretty aggressive, you know, especially given where the market's been in 22. So we think, okay, well, look, if you've been buying down here between $28 and $46 a share, then if you're holding until 80, 88, let's say, that's not a bad return. And so we'll generally define a modest markup zone for these sorts of deep retracements and stocks that have been up in the heavens previously. So TTD, if you go back to the current picks, let's go on to the note where we picked it. This is the same chart, but back in January, and we'd said, look, the stock's dropped somewhat. It's just about in our accumulation zone. It had just dropped into that 61.8 retrace. It was around $46 a share, and we'd said, look, this is worth accumulating at this point, and here's the zone. Now, as time has passed, this is the chart now, and you saw that you did get an opportunity just down into here to buy all the way down to 41 from about 46, and it's since moved up again. So it briefly made a foray into the accumulation zone, and it's now just in the markup zone, and we do expect TTD to keep moving up. What we said at the original note is we had the markup zone here, and our expectation is, again, per the original definition of what the picks are, is once we've chalked up a solid gain in that, we'll close out the pick. But you can see from the chart that we posted originally that we think the stock can go much higher. Now, most likely, things can change, but most likely once we close this out as a pick, if we get another little run up in the stock, we'll close it out at, let's say a 15% return. We'll say in the newsletter service, we're closing this as a pick, X of a return over Y weeks or months. That's, a blah IRR, internal rate of return, annualized rate of return. And this is what we're doing in staff accounts. We're selling out or we're going to hold. And so at all times, what we're trying to do is be completely transparent with what we're doing with our own money. And you can interpret that how you like. You can follow it, not follow it. That's your decision. But our idea here is that we're not trying to run any kind of guru services. I hate guru services because they always go wrong. No one's right all the time, and no one's, my way or the highway approach works ever. What we're trying to do is lay down some good ideas. They are intended to be relatively low risk or good risk return type ideas, and give you the tools to work out how we got there and what we might think happens to the stock in the future and how to factor that into your own work. A frustration with the newsletter, but it's a sort of function of the price release. It's one way. We publish the note and that's it. And there's no chat and there's no comments and there's nothing like that. We host several live chat rooms in our Full Growth Investor Pro service. That's always open to you if you want to upgrade. But in the newsletter, one of the reasons we can do the work at this low price is because it's, hit publish and it's done. So it's low intensity for us. It's a bit frustrating, I suspect, as a member, but that's the quid pro quo for the low price. So if you want any kind of real-time chat, then take a look at the full service, and that has it all the time, where you can talk to us, not quite 24/7, but almost 24/7 about any of the stocks we cover, any of our ratings. We have a big community of really smart investors and traders, and it's a really nice community. People aren't, calling each other names or stock shaming each other. We've got a great community trying to help each other succeed. And so if you're looking for a bit more interaction, I wish we could do it in the newsletter. We can't, but we do it in the full service. So if you ever think about upgrading, that's one of the reasons to do it. Okay, so that's Trade Desk, and we've covered what a pick is, how we come up with the picks on a fundamental basis. We've covered our technical entry and exit ideas. And so we've just got a couple of minutes for any further Q&A if anyone has them. Again, everyone is unmuted my side. So any more questions, do unmute yourself and chat. Or if you can't think of any questions, you can always email us later. There's a contact form on our website. Dominic, your mic's open.
Yeah, so with regard to your picks, do you look for any diversity in terms of sector, industry,
No.
Geography, et cetera?
No. Again, there's a lot of merit to a model portfolio service where people would take care to do that. This isn't a model portfolio service, and so no, there's no thought to, well, hang on, we're heavily tech biased here, or there's too much commodities here. No, this is just a look. Here's one of the stocks or the ETFs we cover. This looks like it's a pretty interesting point right now. I think this is a buy. Here's why, and this is where we think the stock can get to. No, so there's no weighting, or there's not even any risk balancing, which is 5 of these are value, 5 are growth, one's bonds, and one's crazy growth. No, none of that. They're all one shot ideas.
Okay. And what is the universe of stocks and ETFs that you do cover?
So if you, in software, pretty much all the important enterprise software stocks we cover. We don't cover much in the way of consumer internet, because it's just not my background, and I don't like shopping, and I don't have any feel for it, and I don't really know the company. So, Shopify, Square, any of those sorts of things, the crypto names, we do cover Bitcoin and Ether themselves, but any of the associated companies we don't cover. We cover all the major defense contractors. We cover all of the pure play space businesses. We cover some telecom businesses like AT&T, and then we also cover all of the indices. So S&P, NASDAQ, the Dow, the Russell. We cover sector ETFs, so XLC, XLY, XLK, SMH, the 3x ETFs, so the SOXL, SOXS's, all those, and we run hedge trading pairs in the main service. So basically, if you put them into buckets, pretty much all of the main software and semiconductor businesses. So I haven't mentioned, NVIDIA, AMD, Intel, and so on. Software and semiconductors on the one side, space and defense on the other, and then all of the index ETFs and the sector ETFs within those indices.
Okay, thank you.
Welcome. Okay, folks, I've got time for one more question if anyone has it. Okay, well, look, a last word for me, which is very, very grateful to everyone for being a member here. This service has been, I'm delighted to say, a rip-roaring success. It's been really fast out of the gates. Big success for us. Seeking Alpha are delighted with their newsletter platform, many authors on it, and also with ours specifically. So that's down to all of you who've chosen to spend your money and your time with us. So very grateful for it. We hope to keep doing a great job for you. One of the benefits of the service is you get a deep 50% off discount to the full Growth Investor Pro service if you do want to upgrade. I'm conscious we sort of hammer that, a lot, but it's a really good service. And once people join, not many leave, and it's a big discount. So we're a business, we like to sell things, so you'll forgive us if we oversell a bit sometimes. But if you're interested, try it out. It's a great service, and there's a lot more value there. And probably you'll find it's actually better value than newsletter, because you get a war more stuff. So thanks again for everyone, and thanks for joining us today. The recording of this will post probably tomorrow as a newsletter post. And any questions at all, if you go to our website, cestringcapitalresearch.com, there's a contact form on there. If you fill that out, someone will get back to you really quickly if you have any questions at all about the newsletter, about the picks in it, anything you like. So use that. Thanks again, folks, and we'll speak to you all soon.